Hello, everyone. Thanks for tuning in to this edition of our Investment Spotlight. We're covering a very interesting market segment today, and I appreciate you taking the time to join us. As many of you are aware, we've been including more alternative investment solutions into our models over the past few years. This is an area that we continue to expand on and feel provides great value for you, our client. We are big believers that portfolios, including high-quality alternative solutions, provide many benefits to you, including greater diversification, mitigation of volatility, preservation of capital, and the opportunity for enhanced returns. The use of alternative investments is the same approach that many or some of the largest and most successful pension plans, endowments, and family offices have been using for decades. Unfortunately, this segment of the market is often not available to the retail investor due to the general scale and resources required to participate in these types of strategies. As a portfolio manager, I'm always looking for high-quality asset managers to incorporate into our models. After conducting a great deal of due diligence, I'm very excited to share some insight into our next portfolio solution. We are going to be implementing a weighting to secondaries private equity. What is this, you may ask? Well, stay tuned to find out. We will be partnering with Overbay Capital to gain exclusive access to private equity within our models, and I am delighted to have Dan Britnell join us for today's webcast. Dan is the Managing Director in charge of Investor Relations for Overbay. Dan is going to take the next 10 minutes or so to walk us through what the Overbay team does on a global scale, and how they're able to bring previously inaccessible private equity solutions to Canadian individual investors. We have participated in previous Overbay funds and have been very pleased with the results. We're thrilled that we're now going to be able to offer this to a larger range of our clients. Without further ado, I'm going to turn the floor over to Dan for a quick introduction, regulatory statement, of course, and then we'll jump into who is Overbay Capital and what do they do? Dan, over to you.
Thanks very much, Ash, for including Overbay, and congratulations on the institutional style portfolio management you bring to your clients. A quick regulatory statement. This presentation is strictly intended for Canadian residents who are accredited investors as defined by National Instrument 45106 and or permitted clients as defined by National Instrument 31103 and or their professional advisors. Past performance is not indicative of future results. This is not an offering of a security as defined by any regulatory authority. And as always, information is being provided by request, and we encourage every investor to read the offering documents. So let's move ahead. Let's talk about a little bit about Overbay as a firm. We've been in the private equity business, the private equity secondaries business for almost 2 decades. We manage almost $2 billion, and 2/3 of that would be institutional investors. A few analogies might actually give you an idea what a secondaries is in the private equity space. If I was a real estate investor and my goal was to assemble 1,000 condominiums, think of one condominium as a door, and that would be equivalent to a company. But rather than buying pre-owned condominiums or buying, brand new pre-built condominiums, what if I could go out and buy 10 condominium complexes that were diversified in different cities and locations, and each of those complexes had 100 condominiums? And what if I could buy those condominium complexes at 25 to 30 to 35% discounts to the comps in the marketplace? So a lot of professional real estate investors, deep-pocketed investors would say that'd be a great deal. I would do that tomorrow. The catch is you couldn't trade or flip out those condominiums immediately the next day, but you knew that every one of those doors or condos would be sold in the next 3 years. That would be a pretty good exercise. Why? If you're buying that entire portfolio of condominiums at a 25% discount, you've got that downside protection. You're already building in mathematically 1 divided by 0.75 is already up 34% day one. So you're building this increased return, a lot of great risk reward. Similar analogy if somebody went into a yard sale, a garage sale, And there was someone who needed to move, so they were incented to sell everything. And in the corner there, you notice the number of sleeves and entire hockey card collections. And before you put an offer in on those hockey card collections, you went, oh, here's entire sets. Oh, there's some rookie cards from Bellevue. There's some rookie cards from Gretzky. Oh, there's some Connor McDavid's in there. And so you went over to the owner and said, yeah, I know you want $100 for these entire sets, but I'll give you 65. And because they're incented to move and they need to actually sell and liquidate everything and look for cash, they accept your offer. And then you knew, because you're a professional in the industry, the hockey card industry, you knew that you could either sell bundles of those or you could sell them off one by one over the next 1 to 3 years and get your cash and make a nice, handsome profit. That's exactly what we're doing in the pre-owned private equity space. It makes it easy on a look-through basis. You know, we would own over 10,000 companies managed by some of the best managers in the world. And we've got lots of history in the private equity secondaries industry. Now, let me just talk about the characteristics of every one of our flagship portfolios. We've got 3 things that investors can expect. Number 1 is downside protection. How do you not put capital or money unnecessarily at risk? 2 factors there. Maximum diversification. Our portfolios literally have thousands of underlying best-of-breed private companies. At the same time, that discount provides the downside protection. If we're buying a portfolio that's worth 100 million for 75 million, technically all those companies would have to go down and stay down permanently by 25% or more for 1 cent of capital loss. We've never seen that. Wouldn't say it's not impossible, but the world would be pretty ugly. Secondly, enhanced returns. We want to outperform our peers. And that's exactly what we're doing. If we're buying at a 25 or a 30% discount, we're already up 34 to 40% day one. That provides a lot of advanced return right up at the beginning. And of course, we want to actually put our investments in a structure that makes it easy for professionals like you, Ash, to incorporate into their clients' portfolios. Mm-hmm. Here's what we're going to cover off today: the challenges, the benefits of private equity, how Overbay approaches the secondaries market to make it a much better client experience, and talk about the opportunities for your clients to participate in our current offering. You're going to see this in most private equity presentations, that this line here, private equity over any measurable period of time outperforms public markets. That's very true. In private equity, if you put it into a diversified portfolio, reduces risk by units of volatility and then can enhance returns. And that's why the biggest pension plans in the world, like Canada Pension Plan, have private equity as their largest performing asset class and largest weight. Their average annual rates of return have been 17%. So really, really decent. Begs the question, however, how do individuals look to try and mirror or mimic that type of experience without having to be multi-billions? And that's really what we've done at Overbay. Private equity has got some drawbacks, and we're not afraid to actually be very transparent and say, here's the traditional drawbacks of private equity as an asset class. Historically, it's slow to get money working. And it takes years and years to get those companies purchased into portfolios by the private equity managers. It's illiquid. You know, lots of times there's fund terms that run 10 to 15 years. That's not our case, but that's normally the experience. And it can be risky. If you're looking at, you know, the best of breed, first quartile to fourth quartile, who's the best, who's the worst, it's pretty hard to tell year in, year out who's going to be doing that. Of course, our solution is focus on first and second quartile managers, the best, and buy those managers, those portfolios at meaningful discounts so we can enhance returns and reduce risk. As opposed to public markets, mutual funds, it's pretty, you know, narrow as far as who's best to breed and who's not. So we take care of this through diversification. We take care of this through discount. And it's difficult to access for most individual investors. You know, we have some people say to me, I'm in the private equity business. I invested in a private company. Single company risk can be high. It's either going to be a nice performer, or the majority of them actually end up being not so much. Direct funds often have high minimums. We're very familiar at Overbay with private equity primaries. They have normal minimums of $5 to $10 million each, making it inaccessible for most individual investors. The largest investment managers are always oversubscribed by the biggest pension plans, so certainly not a democratic asset class. And if you end up participating in extra fund of funds structure, it can be expensive. So what we see is it's an environment today where we see higher rates are going to be here for a while longer versus, COVID discounts, slower economic growth in various parts of the world. We think there's going to be some volatility both in public equity markets and private markets. Of course, our answer to that is let's be very, very diversified, thousands of underlying companies, focus on blue chip managers, buying those portfolios at meaningful discounts. And in today's world, we're buying portfolios at 20 to 40% discounts. That's up from a range of 10 to 30 pre-pandemic. So what we've got is an environment where we can deploy our strategy. It's almost like an all-weather strategy, no matter what's going on in the economic environment.
Yeah. Thanks, Dan. This is really helpful to gain some insight, I think, into private equity just as a whole. And, love diversification, something that we certainly have in common, something that we're always continuing to do, and where, we think that Overbay is a great fit. Now, further to that, and you've touched on it a little bit, that it is extremely difficult for, if not impossible, for the average investor to participate within private equity. Can you explain to us how Overbay solves that issue and allows investors to participate?
Thanks, Ash. I'd be happy to do that. Let's just look at the overall size of the marketplace. Is it big enough and addressable enough for us to deploy our strategy? The answer to that is yes. Private equity is much larger than public markets. And by the way, private equity is just a fancy name for private companies.
And I think a lot of people actually don't know this, and they don't realize that, private markets are actually larger than public markets.
Correct. And then what percentage of the overall private market industry trades? It's not like a publicly traded company. It's not like, oh, I've got 100,000 shares or 10,000 shares of Enbridge. I'd like to sell that this afternoon. If there was an institution, and let's define institution, insurance company, endowment, foundation, superannuation plan, big institutional investors are the largest investors in private equity. And if they're looking for cash or liquidity, that's just a synonym for each other, they need to find a private buyer. And Overbay's in the private buying business. They could be, over allocated and need to change up their balance. They could have a new chief investment officer take over that pension plan, and typically a new chief investment officer would have a year to change up the portfolio. We find all kinds of opportunities there. So we like to say illiquidity is the opportunity, and we're viewed at Overbay just as a cash utility to these selling institutions. We're providing them liquidity, but a trade-off for that is we're buying their entire diversified portfolio at a meaningful discount, and that helps our fund and helps the investor profile. If I look at what institutions are facing today, there's about $1.1 trillion, which is big in the marketplace globally, of institutions that are overweight private equity. And they would be overweight private equity for good reasons, not bad reasons. They all have what's called an investment policy statement. In the institutional world, it's called a statement of investment policies and procedures that says, I can own X percentage in public markets. That would be stocks and bonds. I can own Y percentage in private markets. And usually that's real estate, infrastructure, private credit, private equity. And those private assets have done very well over the last 5 to 10 years and have appreciated. Public markets have come down over the last year. So if their maximum weighting in private equity by their governing document or governing rule might be 20%, mathematically, they could be sitting at 28 or 30% right now. And so they're forced sellers. That means they need to bring that weight down. And of course, they've got to sell to a firm like Overbay. And what we find is that provides opportunity for us to actually cherry pick high quality. And actually, because we know they're forced sellers, allows us to buy at even greater discounts.
Look for the Connor McDavids.
You got it. We're often asked, why would those institutions look to sell when it seems like the best time to own? And this is an industry diagram. It's called a J curve. And I talked about these long time frames, 10 or 11 or 12 years as far as a limited partnership in private equity. At time zero, you might be investing in a Blackstone or a Carlyle or a KKR. And time zero, they're going out and buying companies. They might own 14 or 16 companies by year 5. And that institutional investor might have committed $50 million here. By the time you hit year 7 or 8, they've got $50 million worth of company sales back. They've got their capital back. And they've made it by year 7, 8, or 9, a profit on that. And those underlying portfolios might have 8 or 10 companies, which are great companies. They just haven't been sold yet. So that institution, if they decide they want to get liquidity, which means cash in year 7, 8, or 9, they've already made their principal back. They've made some profit, and they're just taking a discount on the remaining part of the value. So we actually come in at this point in time where we know the manager, we know what's in the portfolio, we can buy hugely diversified baskets. An average purchase for us is 40 funds representing 400 underlying companies.
I find that slide to be very powerful. I know when we first started working together, that really helped me to understand what the secondaries market is and how an investor benefits in that harvest period. So thank you for touching on that.
So we're solving for risk by diversification. I mentioned 40 funds, 400 underlying companies. We also solve for risk or downside protection by buying at a price that's below the current market value. We solve for outperformance, which is another one of our key 3 pillars, by buying at discounts. It sounds like a nauseum, but that's the real core part of our strategy, is to buy high quality blue chip portfolios below their market value. And this just shows you a representative example. An institution might have $100 million portfolio they're looking to actually get liquidity on. We say, thank you very much. We're going to offer you $75 million for that portfolio. So immediately and mathematically, if we're buying $100 million for $75 million, we're already up 34% day one. We're very conservative as far as our underwriting of the appreciation over that next 5-year period. That $100 million might grow to $115 million. So the selling institution would say that's a meager 15% return. But if our cost base is $75 million and this portfolio distributes back to the fund and therefore our investors $115 million, we've turned it into a very attractive 53% return. So that's a very repeatable strategy for us. We're comfortable. Our area of expertise is we've got thousands of relationships with institutional owners of private equity, and every given quarter we're buying them and putting them into our funds.
Okay. Thanks for that, Dan. I know that you had already kind of mentioned that Overbay has an all-weather strategy, and I think that that's really important for our clients to know as well. Now that we've covered what Overbay does, how you do it, in terms of secondary private equity, could you provide us with some insights on Overbay's track record and some details with what a typical offering may look like?
Sure, be happy to do that. As I mentioned, we have a very repeatable strategy no matter what the economic environment is. If I look at some of the past partnerships and relationships we've had with Richardson Wealth, Fund 14, 15, and some very special situations, they've all had some very handsome net returns. So clients have done very well in working with us. And I want to go through a recent example to give people a visual of how we assemble portfolios. And this is Fund 14. It was a Richardson Wealth offering. It happened in 2020. We like to be very diversified by strategy. Buyout's just a fancy word of companies that are a larger cap. You know, the managers like you see over here, like KKR and Blackstone and Apollo and Carlyle, like to buy companies worth about $1.5 billion and grow them to be worth $3 to $4 billion and sell them. Growth companies, managers like to buy companies worth about 500 million and grow them to be about $1.5 billion. So it's quite a continuum. A little, note on the venture capital side, we do not participate in early stage venture. So what that means is if we don't rely on one company to going up 25 or 50 or 100 times to make up for all the ones that go to zero, but there's something called late stage venture, where it's the last round before a company is sold or last round before it goes IPO. That's very, very attractive inclusion in our portfolios. And of course, if you look over to the right here, these are some of the best blue chip managers in private equity in the world. We assemble them in one fund for one client experience. Once again, we're mimicking or mirroring what Canada Pension Plan would take decades and billions of dollars of capital to assemble. And if we look underneath the hood, as far as the portfolio itself, this means that for every $1 million someone's invested with us, we've already paid them back $550,000, or every $100,000, it'll be $55,000 back to them. Performance-wise, the fund has done extremely well. And here's a sample of the 500 plus exits, which is another fancy way of saying sales, and sales means cash. Cash goes into the fund. And if it's in our limited partnership structure, we'll talk about it in a minute, cash gets paid out to your client's account. Actually, if it's in the mutual fund trust structure, that is accrued in there and reinvested for this compounding growth. So we like to say in one vehicle, in one fund, what we're doing is providing a highly diversified experience and approach to the private equity strategy.
Thank you, Dan. That is quite the impressive track record. Your presentation, as always, was incredibly helpful, and I think it really provides our clients or investors with a firsthand look at what Overbay does and why it's such a great addition to their portfolio. Previously, Overbay was only offered to clients in USD and for non-registered accounts. We have been asking for a while for Overbay to provide us with a strategy that would enable us to implement private equity or secondaries private equity exposure to our clients on a greater scale, for it to be issued in Canadian dollars and to be eligible for registered accounts or RSPs, RIF, TFSA, RESP. Well, Overbay took this feedback, and I'm sure after much scrutiny with the regulators and compliance, we are thrilled to announce that we are now able to actually implement Overbay across our models because these vehicles do exist. So what we're taking a look at now is that there are two structures available for 2023. One will be the limited partnership version, and one will be the open-ended trust. Both do have different minimums associated with them. Now, Overbay will have some flexibility with us just because we are implementing this across our client base. Having said that, there are some different liquidity constraints that we do have to take into account. Normally, when we are implementing alternatives, we do this via our PM license, and we don't have clients sign subscription agreements for this. However, because of the liquidity constraints, so a 2-year lockup period for anybody in the registered open-ended trust, and a 5-year lockup period for anybody in the limited partnership, we will actually be sending out subscription agreements for clients to sign to be able to participate. Now, taking into account, we are doing our own due diligence in terms of the factors that we are going to factor in terms of eligibility. So looking at age, cash requirements, and account size. So just stay tuned. If you do hear from us with subscription documentation, then that means that we do feel that you are eligible to participate. If you have any questions, as always, don't hesitate to reach out to myself or Fabi. We're always here to help. We are really, really excited to be able to offer Overbay's private equity solutions to you. I think that this is a huge value add, and we've been waiting a long time for this. So very, very happy. Dan, thank you for your time. We really value our relationship and look forward to continuing to work together in the future.
Thanks very much, Ash. Reach out if you need anything, anytime.
Okay. And thank you all for joining us today. We hope that you have a wonderful day. We'll be in touch. Take care.